Welcome to part 3 of this webinar series based on the 10 components that you need to become a successful trader. And we're right at the heart now of trading. We're getting right to the heart of technical analysis. And that's a metaphor, and I think it's a relevant metaphor. The third part of this series, we're going to concentrate on making a diagnostic. If you're a professional trader, then you need to be professional, and we need to make a diagnosis on the market that we're trading. We need to understand the heartbeat within the rhythm of the heartbeat within the market that we're trading. Is it in a trading range or is it in a trend? Is it trending or is it ranging? This is the trend and the trading range. These are the heartbeats. This is the heartbeat of a market, and each market has a heartbeat, and there are similarities. Is the heartbeat accelerating? Is the market moving upwards? Is it moving downwards? Or is it rather stable at the present time? It's important to make a diagnosis of the conditions within the market before taking any trade. Here's more detail, and here's why this is so important. Have a look at this. So component number 3 is to understand the difference between trending and ranging markets, a trend and a trading range. Being able to identify different market conditions and the different stages that markets transition through is hugely important. And the reason it's important is because certain trading styles and strategies work in trending markets, and different strategies and styles work in trading range markets. Traders need to alter their trading tactics to suit the conditions that exist in the market that they're trading. Tactics that work in trending markets do not work in trading range markets, or at least, they don't work as efficiently. And tactics that work when markets are in trading ranges do not generally work in trending market conditions. One of the challenges in trading is that some information is missing. We know what's happened in the past, but we do not know what is going to happen. We can assess past data as it's nicely arranged for us on the chart that we're looking at, and we therefore know where orders to buy and sell have been placed in the past. What we don't know for certain is where orders will be placed in the future. And because we don't know this, we need to make an assessment of likely intent to place orders. And we can only do this by making assumptions for the future based on past evidence. And largely, traders will assume that whatever form the market has been taking in the past will continue into the future until some evidence comes to light which challenges this assumption. In terms of trends and trading ranges, this means that traders will assume that when the market's trending, it'll continue to trend, and when it's ranging, it'll continue to range until something changes. They will place intentions to order, the traders will place intentions to order based on these assumptions and this analysis, and these orders will differ based on the type of conditions that exist. So the big question is, how do we know when a market's trending and when it's ranging? So let's have a look at a few charts so that I can talk you through this aspect. So take a look at this chart below. Is the market in a trend or is it in a trading range? It's in an uptrend, isn't it? How do we know that it's in an uptrend? Well, the market's making higher highs and it's making higher lows. So let's look back at the start of it. When did it become a trend? In the bottom left part of the chart here, the market made a slightly higher low and then it moved up above a recent high. And this was the start of the trend.
And this is ideally when it was best to get into the market in the direction of the trend. But it also, at this stage, carries risk because an uptrend movement at this stage is by no means clear. So what measures do we have to tell us that the market's in a trend? Well, we've got the measure of higher highs, higher lows for uptrends and lower lows and lower highs for downtrends. Each bar, each time period and each bar has a high and it has a low, and when the market goes up then it makes higher highs and higher lows, and when it goes down it makes lower lows and lower highs. From a technical point of view, it's often better to look at highs and lows from a slightly wider perspective than just one period, one time period, or just one bar on a chart. And one way of doing this is to use things called fractals. A fractal consists of 3 bars with 3 lows and 3 highs. And when a market's going up, then it makes higher fractal highs and higher fractal lows. And when it's going down, it makes lower fractal lows and lower fractal highs. Looking at a chart is probably the best way to determine highs and lows that are significant. And the best way to see highs and lows is probably via a line chart. Here is a line chart variation of the previous uptrend chart that I showed you. Okay, and now here is a trading range. How do we know that it's a trading range? Well, overall the market is moving upwards, but there's no consistency to the highs and the lows. They are generally sharp spikes, they're quick movements and they have no discernible pattern to them. The market's tending to reverse at almost every high and every significant low. And the markets move from trend phases to trading range phases. And the tactics for trading ranges are very different from trading trends.
In trends, traders wait for pullbacks to value areas before joining the overall trending direction of the trend. The traders assume that the trend will continue and make new highs in uptrends and make new lows in downtrends. And this is where they take their profits. In trading ranges, traders will identify the likely top and bottom of the trading range and look to sell in the top third of the range, taking profits in the bottom third. And they'll also buy in the bottom third of the range, taking profits in the top third. When a market's in a trading range, traders will assume that the range will continue.
If we look closely at our examples again, we can see that if we made the correct assessment of the market conditions halfway through the trend and halfway through the trading range, then we would have been able to confidently place trades accordingly. If we can make an earlier judgment, then all the better.